I see cost segregation providing two main benefits for a property owner. Number one, they're going to be able to keep more tax money in their pocket the year that they do this. They apply the study to their tax return. Again, if you can pull forward a really large, say 20% of that building as an accelerated depreciation deduction into this tax year, you're immediately going to keep, the property owner is going to immediately keep more tax money in their pocket.
Hi, this is Chris German from The Apartment Dealer. Welcome back to The Apartment Dealer Show. With us today, we have Mr. Dave Barrett of Cost Segregation Services, Inc., and he's going to discuss all things with respect to cost segregation. Now, I'm going to venture to guess that many of you, the majority of you, are unfamiliar with cost segregation, or maybe have heard the term, but aren't necessarily familiar with the advantages that a cost segregation study would have for you as a landlord, as an investor of multifamily properties. And that's what we're going to discuss. Now, this is all part of our interview series as we prepare and ramp up for our live Apartment Owners Educational Luncheon. This is where I'll be sitting down with each of the speakers that actually will present at the live event and get a general idea of the content that they look to cover, introduce you to those speakers maybe that you have not met before. Dave will be joining us at our educational luncheon for the first time. So this is a great opportunity for you to get familiar with him and his work. And this is all under the guise of ensuring you, the landlords, the investors, have the right information from the right resources as you continue to own and manage your multifamily properties. So with that, I will welcome to the show Mr. Dave Barrett. Dave, thank you for being with us today.
Well, thank you for having me, Chris. I look forward to the discussion.
Now, our live educational event, which you'll be a part of, this is going to be about our 15th year or so conducting this event. Of course, it would just be highlighting and sharing you to the landlords for the first time. So if you could share a little bit about your experience, background, what brought you to the world of cost segregation?
Basically, it was explained to me probably 10, 12 years ago by a friend of mine in business, and then a very good colleague of mine started working for this same company a couple years ago, 7 or 8 years ago, and told me what a wonderful tax benefit that the property owners were experiencing with this study of their commercial income property. So very happy to see that it's all very true in terms of the tax benefits. They're very real.
In general terms, what is cost segregation?
Segregation, I guess if you look up in the dictionary, it just means, separating, if you will. So a cost segregation study separates everything that you received when you purchased that property, except for land. Land value is removed because land is not depreciated. So everything that's left after the land's been removed from the purchase, we calculate everything in relationship. What is when you bought that property, what was the cost of the AC system in relationship to the carpet, in relationship to the cabinets, in relationship to everything? So it's a very extremely detailed and technical process to do a cost segregation study. There's a lot of ways to do cost segregation. There's even software programs you can buy and do yourself. The only issue is you're going to probably miss a lot of the opportunities because only a plumbing contractor or an electrical contractor will know behind that drywall how much copper is really there, how much piping is really there. Our studies are touched by all the main engineering contractors, if you will, and we put a calculation to literally everything you bought in that building. And more importantly, as technical as this an engineering-based study is, there's only a handful of companies that do engineering-based studies like we do nationally, and we're the biggest provider of engineering-based cost segregation studies. And the most important thing I can mention is we've done over 30,000 studies in 21 years now. We've only been audited 15 times, but every single time the IRS checked off that all of our calculations were exactly correct. Nothing had to change. So we have 100%. And in every study that we provide to clients, in our paperwork is that we guarantee to defend a study if it's ever audited. So it's a very, very specific calculation for what you bought in the building.
Got it. Got it.
Yep.
So who qualifies for a cost segregation study, number one? And number two, does it favor one investor over another, depending on what they own, how long they've owned?
Yeah, great question. Great question. One of the qualifying questions is exactly what you're mentioning. When I first talked to anybody about the possibility of a cost segregation study, the first question is, how long have you owned the property? Because what we're doing is we're separating out all the components that qualify for faster depreciation, which creates more expenses and allows that owner to keep more of their tax money in their pocket. When we do a study of a property, the first thing we would need to know is, have you owned that property? I would say the best time to do cost seg is the year that you buy the property, which I won't go into the details of, but if you can do it the first year you buy the property, that's great. But we can also do what's called a catch-up, where, if you bought the property, let's say 6 or 7 years ago, it would probably still qualify if we went backward to look at what could have been done at the time they bought it, and then taking into account how much depreciation has happened over the 5 or 7 years to see what's left that can still be accelerated. So there is a time frame where it can be done, and there's certainly a time frame where it just doesn't pencil out. We run estimates at no cost for anybody, conservative estimates, to help with that decision. Now, if somebody spent $4 or $5 million, let's say, or more on a very expensive property, let's say it's a commercial property with 39 years of depreciation, I've seen some studies that are 10 years of ownership will pencil out. But again, it just comes down to how much depreciation the tax law will allow them with the components that are in their building actually be accelerated versus the cost of the study, which is basically the time it takes for us to study their building. That's the main component with the cost of an engineering-based study. How long does it take for your building to have every room analyzed for the size, for the carpets, the cabinets, and everything in that building? And small buildings, not as expensive a study. Larger buildings take more time and are more costly. It's just, part of the decision.
Backing up for a second then. So the viewers, 99% of the viewers of this show and who will attend our live event own multifamily properties. And so typically they purchase a property. They advise their accountant the same year of the purchase that they've added a new property to their portfolio. And then the accountant will then begin a depreciation schedule that typically will run 27 and a half years. Maybe they'll accelerate, some of it, but essentially 27 and a half years.
Yep.
Cost segregation, though, functions differently on the timeline, if you could explain that.
Thank you. Great setup to the question. Yeah, with multifamily, your primary people that will be joining us, it is 27 and a half years. And every study that I've done, pretty much 20% of what they're depreciating over 27 and a half years can be pulled forward as a 100% bonus if you bought the property in the last 5 years. If you buy it in 2023 or going forward, the benefit's going to drop from 100% to 80 and 60. But I'll just do a typical Ventura County property. Let's say a quadplex, whatever, in Oxnard. If the owner paid $1.5 million for that property, in Ventura County, it's about a third for land. Roughly speaking, the CPA would probably confirm a third land value. What's left is around $1 million. So it's easy for me to tell you, out of that $1 million, that you could take 1/27th and a half each year. You could decide to pull 20% of that forward, or it could be as high as 30, 35%. I'm just being conservative. Most of the time I see 20, 25%. But yeah, that can be an immediate, wonderful tax deduction that could be taken in this year.
So you mentioned a catch-up study. So that was one of my questions here is, what if you're watching the show today, you're just learning about cost segregation, you're thinking, gosh, I just bought a building 3 years ago, but my accountant's already running that depreciation schedule. Yep. Has all been lost, or you can still do a cost segregation study?
Yeah, thank you, Chris. Yes, you can still do what's called, we call it a catch up, which is just, doing a study now and applying all the tax benefits back to when they actually bought the property. They have to put the property in service. So they have to be collecting rent to begin any type of depreciation. So whenever they put it in service, we could do the calculations back to that day. And there's just something called a 3115 form that's needed. It's an IRS form. It's called a change of accounting form. And it simply switches from the straight line method to the cost segregation method for more depreciation deductions accelerated for for this tax year.
And so you accelerate those deductions, and so then the obvious, I think one of the obvious pros to this approach then is, hey, if you had a 1 year where you did extremely well, you lot of income, maybe you sold the property, you're looking at capital gains tax, and you need some extra shelter. Probably a good year to consider a cost segregation. Aside of that component where, hey, it's a high income year, I just need some tax shelter, what would be another pro to this approach of accelerating the depreciation as opposed to waiting for 27 and a half years to pass by?
Thank you. Another great question. We usually ask, so the qualifying questions for cost seg is, did you buy a building the last 5 to 7 years? We can run a no-cost estimate, a conservative estimate for you. The next question is, do you intend to keep the property? We would suggest at least 3 years, and I'll explain why. I see cost segregation providing two main benefits for a property owner. Number one, they're going to be able to keep more tax money in their pocket the year that they do this. They apply the study to their tax return. Again, if you can pull forward a really large, say 20% of that building as an accelerated depreciation deduction into this tax year, you're immediately going to keep, the property owner is going to immediately keep more tax money in their pocket. So one of my clients built a $25 million building. And the same 20%, he had like a $5 million accelerated depreciation, which he applied, and it offset over $1 million of federal income tax. He called this the best tax-free loan, the best interest-free loan he ever gets. And then he said, because I get it from the IRS, I love it. So let's say you cost seg a property that you intend to keep or pass on to your kids for 10 or 20 years, you're going to get this tax savings today. And let's say it's 50 or 100 grand, which is very common. If you can take that 50, 100 grand plus and invest it in any other asset, if you don't sell that property for say 20 years, you get the use of that investment money for 20 years. Whenever you sell that property, it is recaptured. It does come out of the gain of your taxes. But what a lot of people miss, and unfortunately I'm finding a lot of tax pros miss this as well, a lot of them don't realize when we do an original study of their building, we put value to everything in the building, carpets, cabinets, and everything. But if it's 3 years from now that you sell that property, and let's say we put 50 grand value on the carpet, 3 years later, and carpet is called 5-year property, right? So it's logical with the wear and tear on carpet to take that $50,000 value of carpet at the time of the sale of that property and write the value of the carpet down, let's say to $25,000. I don't get involved in a lot of those conversations. We have tax people at corporate that can help your tax pro through this, but it makes sense to then, when you sell that property, ideally for a lot more money, shift as much of that value of that sale into the land as possible, because it's treated differently by taxes. It's less taxes.
So simply by having this cost segregation study, it also helps you if and when the day comes to, say, sell and cash out, if you're not going to do a 1031 exchange, because you're going to have the various items segmented, and you'll have a stronger argument of, hey, why the whole amount isn't subject to capital gains, just this portion, and the rest of it is subject to a lower bracket, or not a lower bracket, but less of it, a lower percentage of it is going to be taxed, because you actually have the documentation to substantiate that not all of the property, the physical property, is to be treated the same.
Yeah. And thank you for that. I mean, if they can put together a 1031 exchange, find the right property to roll the equity into, that's ideal. This works within a 1031 exchange, and we can quote the other property that they're buying as well. So people that love 1031 exchange, the more they know about cost segregation, they will find it is as good, if not, combined. It's incredible.
Here in California, as you may or may not be aware, a few years back, they passed statewide rent control. And within this bill, effectively, you can't just give a tenant a notice to move out like you could in the good old days. But if you're going to what they call substantially remodel a unit, you're essentially going to go in there, change out the plumbing, the electrical, not just put new kitchen cabinets. Okay, so you're going to do what they call a substantial remodel.
Yep.
You can ask the tenant to vacate in most cities, not all, but most.
Yeah.
So my question then is, somebody's owned a building for 15 years. They now are going to move out all the tenants, and they are going to go through and put new plumbing, new electrical, kitchens, bathrooms, and the whole nine.
Mm-hmm.
Does a cost segregation study help at this point because they've injected so much new capital expenditure into the property?
Any improvements that are done, typically the process is everything you spent. If someone's about to go through that, we can do an estimate before they do the work. If they have a budget for the work they're going to do. Commonly, we're brought in after. Hey, they did a lot of renovation work. Can you do an estimate on what was done? In that situation, we would get a list of all the items that they spent money on: cabinets, plumbing, new bathtub, all of those items in like an Excel spreadsheet. That's going to be shared with the tax professional because the tax professional wants to separate out what can be expensed this year, right? What's left that cannot be expensed in that year it was done is probably going to be, it's going to be capitalized. Capitalized means it's going to be taken on a 127.5. You're going to take 1/27th a year over the next 27 and a half years. But you can as well cost segregate those improvements. Absolutely. In fact, a lot of improvements, it's more than 20% typically, because what's typically being improved on is a lot of the 5-year property that qualifies, which is the carpet, the cabinets, the linoleum, a lot of those, what's called in the tax code 5-year property. So a lot of it can be accelerated.
Now, I imagine some landlords are watching this interview saying, well, gosh, if this is good as it sounds, why has not my tax professional, my realtor, somebody advised me that this is available, the benefits and what have you? So the reason must be because there's an issue with it. Now, you talked about Audit early on in the interview, that you guys basically of 30,000 studies have only ever been audited a handful of times. And even at those times, you were cleared of the audit. But does this trigger an audit versus if someone just plays it right and does the 27 and a half years, doesn't raise any eyebrows? Does this raise eyebrows for an audit?
This has been a tax code, a tax law for 20-some years, about 22 years now. So it's nothing new. The IRS is very familiar with it. They train all their agents on it. And it comes down to I guess why it's not an audit trigger is because if they bang on our study, if they find nickels, if anything, as opposed to there's way more things to look for than this, because we run excellent studies. We have a really good track record. And again, we promise every client to defend the study. But I will tell you, out of the 15 audits we were involved in, one of the IRS guys that was auditing us didn't really understand the tax law. Sure. Our company had to pay to appeal that decision on behalf of our client, and we were ultimately correct. We are not afraid to spend money defending our studies because we know they're done properly. But it's not a red flag. This is tax law. It is tax law. And as long as you have a company that's willing to defend an audit that does everything, there's a bunch of different ways to do cost segregation. And I could give you the IRS guide number and page and email address or website to check it out. But the number one method, the number 1 and 2 method, is an engineering-based study that they recommend based on the construction documents, like we just talked about for your improvement question. The second is doing an engineering-based study of a building that was purchased where it's reverse engineered, which is what we do a lot of. The other ways of doing cost segregation, if you go to the IRS webpage, it's rule of thumb. The other ones are problematic. I would say, and maybe that's why some CPAs are a little hesitant. By nature, CPAs are very conservative people. If they have to put an amount on a parking lot, I mean, if they're going to value just the big thing to help their client, they have to do some work to determine what's a typical parking lot that size. But how strong are they going to feel to back it up? Do they feel they can promise to defend it? See, we're going to not only put value to the big things like the parking lot, but it's incredible how much money adds up on the mini blinds, the ceiling fan. There's so many items in these properties that can be accelerated per the tax code, and a lot of them are missed without an engineering-based study, and that's a fact. I love showing an example of our studies, which are very detailed, which we can do at the conference.
Yeah, and I know at our live event, you're going to get into the nitty gritty. Of course, the landlords in that room, it will be individuals anywhere from a couple who owns, say, a 5-unit building to some that own hundreds and hundreds of units.
Sure.
And they're going to want to see, they're going to say, all right, Dave, proof's in the pudding, show me the pudding, convince me why a cost segregation study is good for me. And we look forward to you sharing that information. I know that my accountant this past year suggested that I have a cost segregation study done on a property that I bought last year. And he said, hey, do it on this property because you bought it last year. You want to do it in the same year, exactly to what you had said. And he pointed me in your direction. That's how we've become familiar with each other. And we're in the process of that study. In other words, I've put my money where my mouth is in trusting my cost segregation study to your company. And we look forward to the findings, and we look forward to having you at our event. Dave,
Sure.
Thank you for taking a few minutes with us today.
Sure.
I know that it'll be very informative come the event itself. And until then, we'll talk soon.
Okay. Thank you, Chris.
All right, Dave, thank you. I hope you found today's interview informative. Maybe you are in need of a cost segregation study. You're just looking to get more information. And for those of you that own in our area of service, the areas that we represent landlords in the sale and purchase of multifamily properties, the time is now to register for our live event. Registrations are now open. Be sure to register early because we get filled every time. And once all the seats are gone, they are gone. We keep the event small and intimate on purpose so that you, as the attendee, have an opportunity to submit your question to our panel of speakers. And essentially that question will get answered in a multifaceted way. Maybe your question has to do with real estate law, taxation, market forecasting, and the rest. We have a whole host of speakers that will be on site to help you walk through the questions that you have. The premise here is that the attendees would walk away with that information so they feel empowered and they know what is the next best step in a world of multifamily investing that can be confusing and complicated, that we take the guesswork out of it. You receive the information necessary so that you have a firm grasp on here's the next step that's going to help me in the building and sustaining of my financial legacy in multifamily properties. Register now. If you have not subscribed to our YouTube channel, be sure to subscribe now so that you get the alerts when we release new videos. You also got to check the box there to be alerted, ring the bell so that you get alerted when we do release videos. And share this video with other investors, other multifamily owners, or anyone who owns investment real estate. Cost segregation can help save you thousands in tax dollars. Why not take advantage? And until next time, Chris German from the Apartment Dealer wishing you positive cash flow, tenants who behave, and much protection from Uncle Sam. Till next time.